Hello once again, everyone. Welcome to another market snapshot with me, Craig Erlam, Senior Market Analyst at OANDA. I'd like to start this video by thanking everyone who came to the seminar on Wednesday. I hope you all found it useful. That was Technical Analysis Level 1. For those of you who are in London, we'll be throwing another one next week. That's Technical Analysis Level 2. You can find out all about it on our Eventbrite page. Just go to eventbrite.co.uk and type in OANDA Europe and you'll find out details for our upcoming events. Just a little plug there, I guess, although we are close to capacity at the moment, so there are only a few spaces available. As far as today's concerned, and really I know I've not done a video for the last couple of days, but with Janet Yellen's testimony taking place throughout the European afternoon, it seemed to make little sense. I was concerned a little that I'd put out a video and within minutes or hours it'd be totally outdated. So I thought I'd let these testimonies pass and then I'd give a bit of a summary really in today's video. In terms of the actual testimonies themselves, I'll be honest, we didn't really learn anything. I guess the markets really did get carried away a bit. I think market expectations have changed quite a bit in terms of the path of Fed rate hikes. But really, Janet Yellen was just very much reiterating what we'd already heard from the minutes, and maybe the fact that markets had written off the possibility of a rate hike in March, the fact that she reiterated the fact that we're still expecting 3 this year. Stanley Fischer last night said the same thing. A number of other Fed officials have kind of towed the same line as well. And the fact that she explicitly said it would be something along the lines of it would be correct to assume or that a next rate hike will come in the upcoming meetings. But again, the upcoming meetings is March, May, and June, and people were expecting June already. So I don't really think she actually gave anything away. But I guess what we've learned is markets don't need the Fed chair to give anything new away. They just need her to give them something to get excited about, I guess. Looking at the FedWatch tool, this is from CME Group. You can see that recurrent probability actually shifted back towards 22.1%. Prior to Fed Yellen's speech 2 days ago, this was about 13%. It got as high as 31, but we have paired those today. The US dollar has paired its gains today. I think it's been on about a 5 or 6 day winning streak. It's down about 0.7% on the day, and that's really been the biggest story today, I guess. There has been some economic data which I'll touch on in a second, but in reality, the moves which we've seen in the broader markets today have been haven't exactly been very large. The only story in terms of these moves has been the fact that we are seeing the US dollar pair the gains. The US dollar index, actually, quite interestingly, you'll be able to see if you've got access to a terminal or even Google. It hit the 50% retracement of the move from its recent highs to lows before turning down. So I am wondering whether the dollar moves that we've seen over the last 5 or 6 days is actually a resurgence in the dollar, or if it's in fact just a correction in a weakening dollar trend, and there's actually further to come. So I think that's going to be interesting over the next few days. But at the moment, like I say, expectations did come forward to March, but it's still nowhere near high enough for the Fed to actually act. May actually became the point at which people started to believe the Fed would next raise interest rates, with a rate hike actually then being priced at above 50%, but that's slipped once again slightly to just below. You can see it's now about 48.8%. And again, the other interesting thing is December. If we looked at December, now this again has probably changed today, but after Yellen's speech, we'd got to the point when the probability of 3 rate hikes by the end of this year had actually nipped just above 50%, and that appears to have fallen slightly back once again, but only just. You look at this and you're looking at around 52.7, 56, 57%, sorry, apologies for the slow maths there. I think I should be doing a lot better than that, but 57% of 2 rate hikes, so that's 43% that we'll see 3 rate hikes this year. Again, that is going to continue to change, but that is a big shift really in market expectations. Like I say, the economic calendar, we did have a few things that we were keeping an eye out for today. The Australian employment report on the face of it looked encouraging, but the underlying factors were less so. Unemployment fell to 5.7%, but this came on the back of a drop in the participation rate, which may have flattered that number somewhat. Employment was actually higher than expected at 13,500, but you look at the breakdown of that, and part-time employment rose by 58, and full-time employment actually fell by 44. So again, very flattering, the headline figures here. The underlying numbers aren't exactly too encouraging. We did see some better US data out with housing starts and permits, building permits exceeding expectations. Jobless claims, again, another incredibly low number, and the Philly Fed manufacturing index far exceeding expectations, and yet none of this was good enough to help support the dollar. It does seem that fundamentals and the fundamentals aren't exactly supporting the charts, and I'm not talking about just the US dollar at this moment. You look at Brent crude and WTI crude, these bottom left two charts, we're trading not too far from the highs of the most recent ranges, and this comes on the back of 2 consecutive weeks now where we've had massive inventory builds. Last week it was 13.8 million, one of the highest inventory builds we've ever had. This week it was 9.5 million, again a very high build, far exceeding expectations. And Brent crude, WTI crude seems to be shrugging it off largely. Potentially, these reports from OPEC about compliance with the cuts is having a bigger impact here, but other markets as well just doesn't seem to be complying. We look at euro dollar, for example. Let's bring this in. I've just got a little bit of news here because we did have the ECB minutes as well from the most recent minutes and meeting, and I think the most notable thing that came away from this was that they said. The ECB said in the minutes that limited and temporary deviations from its capital key were possible and inevitable, and this has actually triggered a fall in Italian, Spanish, and Portuguese yields. Now, for those of you who don't understand what the capital key is, the capital key is effectively a breakdown of how much the proportion of bonds that the ECB must buy from each country in order to comply with the rules. That's the capital key. The proportion of bonds that the ECB must buy is relative to how much each country has invested in the ECB. So what proportion of funding comes from each country. Of course, Germany is by far and away the highest. And this has been one of the restrictions that the ECB has had, it's believed, over the last 6 to 12 months, is that it's running out of available debt to buy from Germany, while remaining within a number of its other structure rules that were put in place when the program was put together. And therefore, but while it was running out of German debt to buy, it couldn't just buy Italian debt or Spanish debt instead. Because of this capital key requirement, you have to the number of bonds that you buy has to be proportionate to your how much their country contributed to the budget. So they had to find ways for them to enable them to buy more German debt. Now we saw the solution for that at the last couple of meetings, at least a short-term solution to that at the last couple of meetings. But the fact that they said that they will likely deviate from the capital key did open the door to the potential for Spanish, Italian, and Portuguese debt to be bought up more so than the markets had currently anticipated. So that's helping those yields today. And yet the euro is on the rise. Now I think the euro is on the rise against the dollar, broadly speaking, because the weakness we are seeing in the dollar. We saw that nice rebound yesterday, despite the fact that we'd had all these hawkish comments from different Fed officials, despite the fact that we've had plenty of good economic data from the US over the last 24 hours, and yet we've seen a surge in euro versus the dollar. Now we are trading at around 106.75 now. This is the 50% retracement of the recent swing high and swing low. I think just above here around 107 is key for me. So this is where we approach a 61.8% retracement. It's a round number, but it's also the top of the moving average band as well. So this is the 89-day simple moving average band. If we close above there, then that could be quite a bullish signal and could trigger a move back towards around these 108s, whereas a rebound off the potentially rotation lower could be quite a bearish signal, potentially signaling a much greater move lower. The fact that we've started seeing the pair topping around these levels previously, and we've only just broken below the neckline, so it leaves me with more of a bearish stance, but I'm finding it very hard, more of a bearish bias, but I find it very hard to ignore the moves in the dollar right now, because there still does seem to be more appetite, more bearish appetite than people would expect at the moment, and it'd be silly to ignore that. There's no update really on cable. We're seeing a little bit of strength today, but really this is just consolidation, to say the very least. You look at the 4-hour chart, I think these two moving averages bands could be interesting. We've made a series of lower highs still, even though we do continue to push higher. A breakthrough these 125.50s could signal a broader move to the upside, but we're making a series of lower highs and higher lows, we're not seeing any sign that this is going to change at the moment. Potentially that dollar weakness may be enough to trigger it through, but 125.50 remains important here, and this little moving average band around 124 I think could be key to the downside. But again, it's not one I'm getting overly excited about right now. As you can probably tell by the tone of my voice, because we are just deep in consolidation phase. Euro sterling is creeping higher. It continues to find support around these 84.50s, 85s. This was an important support that I was talking about, because a break of that could trigger a move back towards these kind of 83.75s through 83s. 83, of course, being the neckline of this longer term head and shoulders, which a break of which would be extraordinarily bearish. But then you've got the moving average band, the 200 and 233 day simple moving average band. Again, I've highlighted this on previous videos, so I don't want to go into it too much. If you want more information, check out our last video that we did. But we are seeing a little bit of a retracement here. Assuming we stay below these 86.50s, which is the most recent high, then I think I continue to be a little bit bearish on this for now. I think the Australian dollar, US dollar has seen a break over the last 24 hours. We've broken through the 77 highs. We came off the 50 fib. It looked as though we may be forming a double top at one point, but we didn't break the neckline around 76. Instead, we broke 77, which is a bullish sign. Interestingly, though, you can see here that the stochastic is showing slight divergence with price action, although this is a fresh break, but the MACD histogram is showing strong divergence with this break. So that suggests to me that the momentum is still, while we are seeing these higher highs being made, the momentum is not exactly with the bulls at the moment. And when you consider the fact that this is a very long-term important area of resistance and support, primarily resistance, I should say, from June of 2015. It's no surprise maybe that we are seeing the momentum starting to fall out of this rally at these latter stages. If we see a breakthrough 78, then that would certainly be extremely bullish. I'm not sure if there's an update on CAD. CAD we hit 130 again, and then we've rebounded higher. The same applies really in dollar CAD as what I've said in previous videos. 130 is your support, 132 is your resistance. We're waiting for a break of them really to give us any sign that we are seeing a break in either direction. The simple fact of the matter is we've got this strong support. Technically, this is relatively bearish because we're seeing a series of lower highs being made since the end of December, and we've got this solid support around 130. Should this trend continue, then I think this support could potentially give way, which would be quite a bearish move. Initially, we'd be looking at support around these 128s to 120s, 127.75, really 128.25. You can see this series of supports here. And then further below you could be looking around these 127s, but at the moment 130 is holding, and it's held again once again today, so this consolidation could last a little bit longer yet. I don't think there's any update on New Zealand dollar. Oh no, my bad, there is. We did rebound off these 71s just above, actually around 171.25. That coincided with the 50% retracement, but also this confluence of moving average bands. Again, the US dollar helping this move at the moment. 72.50 really, this prior area of support and resistance, or 72.40 is the next test for this pair. Should we see a break above here, then we could be looking back towards these 73.75s. The highs that we hit previously, whereas a rotation back to the downside could see this 70, these 71, 71.25s coming under pressure once again. Dollar yen, we're continuing to trade in this Ichimoku cloud, and increasingly it's starting to look under more threat than we would have previously anticipated. Again, this is one of those cases where the fundamentals really don't agree with what's happening, I guess, on the charts to an extent, even though that might sound illogical. But we've hit the top of this moving average band, and that is quite a bearish signal, and we're now trading low. You see how long it took us to move from these lows around 111.50 through to 115, and then we hit that moving average band, and all of a sudden we're right back at 113 again. The move lower in this pair is far more aggressive than the move higher, and for me that's quite a bearish signal. Again, we're still in the move, we're still in the Ichimoku cloud. we've come in from above, so it's still bullish, but there are red flags appearing right, left, and centre at the moment. And again, this 111.50 zone is going to be important. This is your previous low. It's a private zone of support, and then you've got the bottom of your moving average band. Then once again, a break below here, and I think this comes under severe pressure, and 110 again becomes absolutely crucial. I know for certain there's nothing to update on Euro Yen. There is a small update in Sterling Yen because we've seen a similar move off the top of the moving average band. So again, this starts to look a little vulnerable. And again, the previous lows do start to then become quite important. This is around the 138.50s, but again, ultimately, it's the bottom of the Ichimoku cloud around the 137.50s, which is particularly important. The gold is benefiting greatly from the dollar weakness today. When it looks like we're going to be testing these new highs around 12.44, we've seen a nice resurgence off the 12.20 support level. Ultimately, 12.50, 12.55 continues to be important as far as I'm concerned. We had this little correction, but really the trend really since the middle of December has been bullish. 12.50, maybe even really through 12.60 is extremely important for me. You got 12.50 is a key psychological level for this. It's also the 61.8% retracement of this move from the most recent swing high to lows, and then you got the confluence of moving average bands, the 200 and 233 test here. So this band really is extremely significant. I think it's also significant that if you look at the most recent highs, momentum is falling out of the move. So at the moment, I'd be surprised if we see this level broken. But again, a few things seems to be catching me by surprise at the moment, because ultimately the charts seem to have a little bit of a mind of their own, I guess, at the moment. They're still volatile, but the fundamentals don't quite seem to be tying up with the technicals at the minute. But like I said, we'll see how it goes. I guess that's the benefit of technical analysis. Fundamental analysis can often cloud the judgment. It's one of the downsides, I guess. Whereas if you're just paying pure attention to the technicals and ignoring what it is that you're trading, then you'll probably be doing okay, and be less confused. But anyway, I hope you found that useful, guys. I will hope to do a video once again tomorrow ahead of the weekend. But aside from that, good luck with your trading. Any feedback, as always, is very, very welcome. For more in-depth news and analysis, check out OANDA Market Pulse at marketpulse.com. You can also find out more about OANDA and sign up for a free demo account at oanda.com. Here you'll also get access to OANDA Forex Labs, which has a lot of great tools designed to help you with your trading.